The Canadian economy and financial system face a new threat. A long-lasting trade war poses the greatest threat to the Canadian economy. The unpredictability of U.S. trade policy could cause further market volatility. Market volatility could turn into market dysfunction. Still at high levels, some households and businesses may be unable to keep up with payments. Banks could cut back on lending in response. Each year, the bank assesses the stability of Canada's financial system and highlights risks that could threaten that stability. While some risks have diminished, the current trade environment has pushed risks higher overall. But let us look back for a minute before we look ahead. The country's financial system has faced unprecedented shocks in recent years, and it has proven resilient. Households, businesses, banks, and other financial institutions weathered the upheaval of the pandemic and the sharp rise in inflation and interest rates that followed. It was a difficult period for many Canadians, and pockets of stress remain. But proactive steps taken by households and businesses, together with substantially lower interest rates, put the system on a more resilient footing heading into 2025. Now the Canadian economy and financial system face a new threat. U.S. trade policy has taken a dramatic protectionist shift. Tariffs and uncertainty have sharply reduced prospects for global economic growth, and financial markets have been rocked by chaotic policy announcements and reversals. A long-lasting trade war poses the greatest threat to the Canadian economy. It also increases risks to financial stability. There are two key concerns. In the near term, the unpredictability of U.S. trade policy could cause further market volatility and strains on liquidity. In an extreme case, market volatility could turn into market dysfunction. In the medium term, a prolonged global trade war would have severe economic consequences. It would reduce growth and increase unemployment. This could, in turn, have important ramifications for the financial system. With debt still at high levels, some households and businesses may be unable to keep up with payments. If loan losses occur on a large enough scale, banks could cut back on lending in response. This would exacerbate the economic downturn and put more pressure on businesses and households. What we are evaluating in this report are the indications of stress in the overall financial system. There are many uncertainties. We still don't know what tariffs will remain, whether they'll be reduced or escalated, and how long all of this will last. That makes it particularly difficult to anticipate the risks to the financial system. In our April monetary policy report, we presented two illustrative scenarios to show how a trade war could affect the economy. In the FSR, we focused on the more severe of those scenarios to explore how the trade war could affect different parts of the financial system. To be clear, our analysis is not a projection. It's an assessment of vulnerabilities, pockets of existing or potential stress that could spread across the financial system. So let me now turn to the Senior Deputy Governor to outline these vulnerabilities and how they affect the four key sectors of our financial system: households, businesses, banks, and institutions known as non-bank financial intermediaries. This is a broad category including finance companies, pension funds, insurance companies, and fund managers. Carolyn.
Thank you, Governor. I'll start with households. Total debt relative to disposable income is lower than it was a year ago, but still high by historical standards. Despite lower interest rates, signs of financial stress have risen over the past 12 months, particularly in households without a mortgage. For example, the share of these households that are behind on credit card or auto loan payments has continued to go up. Among households with a mortgage, about 60% are facing renewal this year or next. Most of those renewing will see their payments rise because they took out their mortgage during the pandemic when rates were at historic lows. But the average increase in payment will be smaller than we expected a year ago. Still, if a large shock causes job losses, it'll be harder for some households to keep up with their debt payments. A prolonged trade war may be that shock. It would cause demand for Canadian exports to fall. It would disrupt supply chains, threatening jobs and incomes. Workers in trade-dependent industries could find it particularly difficult to continue managing their debt. A prolonged trade war would also matter for businesses. Most Canadian businesses have managed to adjust to past interest rate increases, and the surge in small business insolvencies last year proved to be temporary. But businesses in trade-related sectors, especially those with high debt, low profitability or cash reserves, could also fall behind on debt payments. A strength in our financial system is that Canadian banks are well positioned to absorb higher credit losses. Banks have increased their capital buffers in recent years, and more recently they've also increased their provisions for credit losses, and these both bolster their resilience. Liquidity levels remain high, and access to funding for banks is also good. But if credit losses occur on a large enough scale, banks could cut back on lending in response. Struggling households and businesses would then have less access to credit to get through tough times. This cycle could exacerbate the economic downturn. In the non-bank financial sector, the growing presence of hedge funds in the market for Government of Canada bonds raises some concerns. Government bond markets are the foundation of the financial system, and they need to function smoothly for all other markets to work well. The increased activity by hedge funds has helped absorb increased issuance of government debt, keeping yields lower and liquidity higher. But hedge funds have also taken on increasingly large amounts of leverage to fund their purchase of government bonds. And this makes them more likely to pull back from these crucial markets in periods of stress, introducing added volatility. The recent gyrations in the U.S. Treasury market clearly illustrated this risk. If the trade war causes a larger spike in volatility than we've seen so far, leveraged hedge funds might rush to sell their holdings. That could strain liquidity across core markets, increasing stress throughout the financial system. Moreover, the growing connection between banks and non-bank financial institutions could make it easier for stress to spread. Against that backdrop of increased market volatility, and given their importance in the government bond markets, hedge funds need to make sure that they're prepared to respond to sudden liquidity needs without disrupting broader market functioning.
Firstly, how much responsibility does the Bank of Canada ascribe to itself when it comes to the rise in household balance sheet vulnerabilities in the last decades?
Look, I think the purpose of the report is to highlight where the vulnerabilities are. And why do we do that? Well, we do that to help the financial system prepared for worst case outcomes. So, I mean, coming to households, household indebtedness has risen now, going back, a large number of years. I'd have to actually go back to put a number on it, but we've been expressing concern about rising household indebtedness for many years now. And that's happened against the background of low interest rates. It's happened against the background of high interest rates. So I think it's a broader issue than monetary policy. What we saw last year, actually, is the combination of a strong income growth and also lower interest rates. You actually saw households' debt relative to income start to move down. I think the ratio went from the high 70s to the low 170s, not 70s, sorry, the high 170s to the low 170s. So it was moving in the right direction. And when you combine that with lower interest rates, our assessment is that for most households, that is making servicing their debt more manageable. The big message in this report is we now face a new threat. The trade war poses new risks. So even if things were moving in the right direction, it's a really good time to get prepared for possible turbulence ahead. And
just to follow up on the new threat, How do you view the U.S. president's threats and pressure on Powell and the Fed from a financial stability perspective? Is this a risk?
Well, look, the independence of the central bank is sacrosanct. I mean, it is a key element of central banks around the world. There's a reason you have independent central banks, and the record of independent central banks with clear mandates, in our case, an inflation target, has served Canadians very well, and similarly in other countries. So I don't think you want to threaten the independence of the central bank.